Hey, how's it going, everyone? Mark Anderson here, construction worker turned zero DT hedge fund manager. Today, I wanted to speak a little more about some quantitative concepts when it comes to trading in zero DT. Basically, the simplest way I could sum this up is trading is an art. It takes time, it takes experience. There's stuff we can't control. However, math is an exact science. And if we build a lot of our trades while seeking to utilize concepts of math that we know can have inputs and outputs, that will yield a better return, it can drastically help us. So the cornerstone of all of this is when we're trading zero DT options is we have a huge amount of opportunity to compound, and there's also a lot of access to synthetic leverage by trading a $600,000 product in SPX with nickel wings. So these benefits of rebalancing or returns over a period of time can be drastically, heightened from doing this. So the concept I kind of wanted to touch on would be the difference between arithmetic returns and geometric returns. And to basically describe this simply is arithmetic returns would just be the, adding up each individual occurrence. Like if you make 5 cents plus 5 cents and there's basically no variance or out of sample data in that. Geometric returns would basically be the multiplied returns over a period of time. The best way I could kind of display an example of this is a lot of people have been in credit card debt in their life, and a lot of people have been in mortgage debt throughout the course of life. So mortgage is basically compounded yearly. So it's much less of a debt burden, and it's not, near as high of interest you pay. And credit card debt is each day, geometrically, they take the interest that's charged per daily, and then they add it onto your balance, and now you're paying the interest on that, and it's at a much higher rate. So you can just see the difference between compounding with credit cards and at a higher rate versus compounding in a mortgage in a lower rate. So another way we could look at this too is if we were thinking of, geometric returns do not exist in a vacuum. Basically, everything grinds down to geometric returns over time. So that is the culmination of all drawdowns and all, outsized events of making money over a period of time. So a way to look at that is if waves against a cliffside, each individual wave is one occurrence. But over time, everything will basically grind down into sand and the hillside will continue to retreat. And that is the geometric return. And the key concept we need to think of here as well is drawdowns. So if we have some type of hedge, let's say it yields $0 over the course of the year. I'm going to use a little bit larger numbers here so we could get a more clear example. But you would have had, every time you have a 5% drawdown, this basically eliminates it. So if you eliminated 5% drawdowns over the course of the year, you need roughly a 5.5% return to get back from, 5% drawdown to even, or 5.25% return. So even though that hedge has a negative expected value or break-even expected value, by it buffering the times you lose, or it's inversely correlated, it can actually add, 2% return to your portfolio, which when that's compounded day over day, each and every day, that singular hedge as the sum of the whole could actually make a better return for the entire portfolio over a period of time. And when we're also looking at this, it's, important that we create as many occurrences as possible. We have good data. So many contemporary strategies may only be looking at 2022 onward, which 2022 and 2022 and 3 could be the outliers or they could be the normal. But this overlooks key market events that have shaped the landscape prior to that period. In my view, a robust strategy should incorporate a broader historical context, ideally from 2014 forward. With zero DT, we have 2016 forward. This encompasses the 2014 October market crash, the 2015 market correction, the prolonged bear market of 2016, the low volatility Trump run-up of 2017, the significant decline of the Fed in 2018 from rising rates, the rapid downturn of 34% in less than a month during COVID, the rapid increase by the central bank in unprecedented rate increases in 2022, and the recent speculative boom of AI in 2024. Such an extensive data set not only tests strategies against diverse scenarios, but also validates the underlying hypothesis driving its design. Regarding risk management drawdowns, we advocate for a well-structured, diversified, and meticulously tested trade developed to effectively reduce risk and limit max drawdowns within our portfolio, hence limiting the volatility drag. Minus 10% drawdown takes 11% return to get back to even, therefore 1% tax to get back to even. It's essential to recognize that drawdowns alone do not equate to risk. Rather, it's a multifaceted concept that can be managed through effective risk mitigation strategies. Again, a risk or hedge mitigation strategy that reduces the amount of drawdown you have or volatility tax lets you get into compounding Therefore, the credit card debt working for you, you not being the credit card debt. By controlling drawdowns, we enhance the potential for geometric returns, allowing for more attractive compounding over a period of time. When I first wrapped my head around this concept, I realized just how powerful it is. In short, this implies we can actually make more money by trading smaller amounts thanks to the enhanced compounding and the reduction of volatility drag. The key here too is we're targeting around that 5% drawdown, because therefore the benefit we get from the compounding on the upside is drastically more than the tax we could potentially pay on the downside. An example I really liked to simplify this is from Mark Spitzendale's book used in Safe Haven, was that of a merchant company with ships in Europe that were prone to pirate attacks. They determined that 1 out of every 20 ships would sink. For each sunken ship, they lose $10,000. Their insurance offered $600 per sunken ship to insure. Seems like a bad bet, right? You would pay $12,000 in insurance for those 20 ships. That is more than the $10,000 you would lose for 1 out of every 20 ships on average being lost to pirates. But it isn't a bad deal when we look at it geometrically. Therefore, it's not the full story. And in this zero-sum game, we could actually both make out better. The stable cost of sailing for $600 per ship and not having a $10,000 cash drawdown actually generates more dollars over time. It's a win-win for both the merchant company and the insurance company, therefore a paradox. Let's say the monthly profit of the merchant company is $20,000. The cost of insurance is $600 per ship, or a minus 6% profit. The cost represents a volatility tax of 0.38% for every minus 6% drawdown. It takes a 6.38% gain to get back to even from that. However, when the merchant company experiences a ship lost to pirates without insurance, it experiences a drawdown of $10,000 or a minus 50% drawdown of their revenue, requiring a 100% gain to get back from that drawdown. One mustn't forget that the merchant company is actioning his money to increase business. This is the main theme here, being that the faster time velocity you have of money, or the faster you can deploy your money over and over again, like we can daily in 0DT, the more benefit we get from these geometric returns in being able to deploy the capital. So even though this is present in all aspects of trading, life, and risk, it's especially important, let's say in 0-day options or short-dated investments in which they can compound a lot and you're confident you have an accurate price for an edge. So having less cash drawdown allows for better compounding in the number of ships we can then in turn send. Having and recovering from that 10K drawdown is more than the cost of paying the 12 grand to insure those 20 ships. Go figure. On paper, it's minus 2K worse, but geometrically, it's actually better. The entire premise of my trading and my portfolio construction is the style of risk reduction by reducing the risk I hold while also being very clear on what my max drawdowns can be. Therefore, the volatility reduction by way of diversification to provide better geometric returns over time. With smart, defined ways to reduce risk via diversification, my edges can compound. Another kind of concept I like to talk here is, I've heard it online several times, is the dragnet theory. So when people fish for, let's say, blue crab, they drag a net across the Gulf. They'll pick up shrimp, blue crab, and flounder. These are all bycatches. But therefore, by picking up all these edges or all these fish on the bottom of the ocean, we therefore can diversify if the price of crabs go down or if the price of shrimp explodes. And therefore, by having different edges, whether that be long volatility strategies, longer duration strategies in 0DT, or 0DT with different stop loss multiples throughout time of the day, we therefore can have more diversity of edges, which even though they may not all be the most profitable or best trade as a whole, by combining them, it again reduces drawdown and creates more consistent returns so we can compound more over time. Okay, so to best kind of define this geometric return versus arithmetic returns, I wanted to kind of bring some examples to you guys to see if this helped at least wrap the concept around what it is, because my main goal is to show you guys how this can work, and then hopefully you go apply it and kind of learn. I'm trying to teach you how to fish. So the first concept here is we're looking at basically a long straddle. Okay, so this long straddle has positive expected value. So this is great. You know, it's basically saying that you can make money to hedge. And even though it has a pretty rocky route, it in turn basically has a positive expected value. So it's free. And then the counterpart to that would be, okay, well, do you want to use this instead of 5-cent wings to cap your buying power because, hey, it's a long and it's expected value positive? Would you do that? And the comparison to that would be basically this. So you see this trade, it's buying a 5-cent wing for a put and buying a 5-cent call throughout the course of the day, and it loses money. But even though it constantly loses, there's not really a rocky P&L. We just know it's basically throwaway every day, and then it may hit once. Whereas this one, which is 1/10 the size notionally, basically, of what we're doing, is it's got a really rocky route to get there. So this is really going to jack up your geometric returns, whereas this isn't really going to jack up your geometric returns because you could just write it off 5 cents we lost each day. And then the other side of that would be short premium trades. So when we look at a short premium trade, let's say we're looking at a naked put. Okay. So this is just $2 and we're going to offset it with a straddle. So you can see this makes money, 32 grand, 15% PCR looks pretty good. And then the second we throw the wing in, same mechanics, 4x stop, all of a sudden we go from making 32 grand to losing 2 grand. So again, this kind of shows, what's the route you're basically using with these. And then the last part would be how big is your stop on your shorts now. So if we look at this, we can see that this trade is a 15 delta put 90 days out, no stop loss and just profit target. It's got a 52% capture. But again, the route is extremely rocky because you can have that COVID drawdown, yet it looks like a straight line. Then we have using a stop loss, a 2x stop loss, and you can see now the route looks rocky, but same position size, it's a much more manageable drawdown. So if we have this, we need to make 8% more return to get out of a 25% drawdown, basically, because we're going to need a 33% return to get back to even on a 25% drawdown, which is here with a 4% drawdown. We basically need, 4.15% to get back to even. And I'm not trying to say any of these are necessarily prescriptive. I just wanted to show kind of with very limited management data and comparing two things, apples to apples, how it can be different. So when you combine all these concepts together in your portfolio, you can definitely create offsetting positions that with the sum of the parts becomes greater than the whole, but you always have to think of risk management first. So if we're looking at this is a one lot, 5.3% drawdown. This one is a 1, 2, 3, 4, 5, 6, 7 lot daily, and it's only a 7.6% drawdown. So this roughly has 5 times the size of drawdown on it. But then when you look at this being naked, we're getting 32 grand per lot, whereas we're losing 2 grand per lot now when we're paying for that 5-cent wing. So maybe we just trade a much smaller size on what this is, and we offset it with a straddle. And then here we can look at no stop loss management, and it definitely works until it doesn't. You could say, oh, but some of these did expire in the money. And then we look at something for the short side for our credits, this would be a massive drawdown that would hurt us. But on the flip side of that, if we manage that risk, we can deploy more premium. And this is another thing we need to understand is it's like there's two concepts. There's our capture rate and how efficient we are at producing income off of selling basically a risk premium. And then there's the pool of risk which we sell that premium. So like if we have a much higher pool like this, even though it has a lower capture, we can sell it every day because the drawdown is 1/5 as much. So you can see here, we're taking this 5 times a week. This one, we're taking it 5 times a week. And the return is 310 versus 151. But our drawdown is minus 23 versus 4. So we could just sell much more premium in this trade and we're going to have a lower drawdown, and that works. And then maybe we figure out how to work in the straddle or some other stuff. And this is the whole concept of we're making money through income while limiting our drawdowns as much as possible to enable us to compound better. And that's with different sources of edge. That's with different ways of seeing the risk reward of these. But in general, like we're always going to buy nickel wings because we want to define what that risk is to an absolute term. And we know because the only thing that's guaranteed to set off is same duration and same side, basically. So we know in a vertical spread like this is our max risk. They're both 0 DT. Whereas if we were trading this naked and then we were trading this 7 DT, these don't necessarily offset each other. They most likely would do pretty well, probably more so with this one, and the straddle would offset each other well. But just a concept I wanted to introduce to you guys. If you have any questions, drop them below, of course.